It's a bloodbath on global exchanges. Despite all the warnings, investors are doing exactly what we're not meant to do in a situation like this. They're panicking. The Dow Jones had its worst one-day point drop in history, tumbling almost 4.5% yesterday. I'm scared to look today. Like so many people who hold stocks, the virus has well and truly infected Asian exchanges. Shanghai's composite down by 3.7%, a similar case for the Nikkei in Tokyo, considering that they could be calling off the Olympics. We're not sure yet. It's planned for July, August, and Hong Kong's Seng closed down by almost 2.5%. I've been hearing stories all day of panic. Lots of travellers have been cancelling holidays, people in some parts of the world stockpiling food, others stashing away medicine or hoarding protective masks. Chemists here in Berlin have been running out. Disinfectant is in high demand, and supply chains in general are faltering. The urgency all mirrored on financial markets.
Markets around the world are sinking fast. It's the worst week in a decade for global stocks. And investors in Hong Kong aren't the only ones seeking safer territory. In London, where some firms like Chevron sent their workers home this week, the FTSE dropped 4.5% early on Friday. Elsewhere in Europe, losses on Frankfurt's DAX index reached more than 5%. Germany's and the world's biggest chemicals maker, BASF, says it's braced for the unpredictable impact of coronavirus.
Danke, Hans.
Lower demand and production outages in many industries are already visible consequences of the measures taken to prevent the further spread of the virus. We anticipate that the adverse effects of the coronavirus will have a significant impact worldwide, particularly in the first and second quarters of this year. As the coronavirus continues to spread to more and more countries, so does its negative impact on their economies. This is Milan in northern Italy, Europe's worst affected area. Normally busy tourist hotspots are now deserted and restaurants are empty. The International Monetary Fund says it's still getting to grips with how deep the global effects will be.
The virus is going to have an impact on growth. A lot just depends on the speed of recovery in China, in other countries, the spillover effects, the effects on supply chains.
With concern about the economic and health implications of coronavirus growing, governments are looking for global solutions. But experts warn that the world is not prepared for what may be down the road.
OK, let's bring in Andrea Heng in Singapore and Chelsea Delaney in Frankfurt, our financial correspondents. Chelsea, starting with you, crash or correction? What are we seeing here?
I think for now it's a correction that could very easily turn into a longer-term crash. Investors are very concerned, A, that this could turn into a global recession, but B, also about the unpredictability of this situation. We don't know at this point how much further the virus is going to spread, what this is going to do to businesses, if it's going to lead to more production shutdowns, to more supply chain disruptions, how this is going to impact consumers. So there's all these big questions that are really unanswerable right now. But if this does turn into a global recession, this could certainly put an end to this 11-year rally in stocks that we've been in.
We've had good times. Andrea, to steal a term of yours, the numbers are dropping like flies today. But what's interesting is there's no single safe haven that investors are running to.
You're right over there. And it was red, all of the markets, probably redder than the jacket that I'm wearing right now. Even here in Singapore, stocks were tumbling down to a 15-month low. The benchmark STI dropping down to 3.2%. But since you're asking, there actually is one safe haven that investors are looking to park their money at in these jittery times, and that's technology stocks. Now, according to one report, investors found that technology stocks are the more resilient ones compared to traditional blue chip stocks, and so a lot of people are pumping their money in there. Analysts say that there are two reasons to this. It's a show that the government, Chinese government particularly, is introducing the right support measures amid the outbreak, but at the same time, it's also because Chinese consumers themselves are starting to look at technology stocks and technology products ever since the US sanctions on China.
OK, Singapore is a hub of oil activity. Tell us what oil markets are doing this hour.
Well, obviously, it is tumbling there as well, but the coronavirus isn't the only reason for the lower numbers in the oil markets. There's also one other culprit, and that's Asian demand in general. Now, just to give you some numbers, Ben, analysts say that the demand in Asia for refined oil products is going to tumble rather, and that number is 380,000 barrels per day. Now, just to give you a comparison, that number in 2019 was 780,000 barrels per day. It's a lot to do with the slower economic activity in China, yes, due to the coronavirus outbreak, but also with the recession that's looming because of the US sanctions. They're putting a lot of pressure on the Chinese economy, so demand generally is slower, and producers are slashing operating rates. Climate change is actually the second biggest reason behind this, with warmer than usual winter months contributing to those lower numbers.
And the travel industry, of course, is one that needs a lot of oil. It's going through its worst week since 9/11, Chelsea.
Yeah, the Stock 600's travel and leisure section, which mostly includes airlines, is down a whopping 20% this week. Airlines have obviously been hit really hard by having to cancel flights to China since last month, but they are also now facing similar travel shutdowns, travel bans, and other disruptions for the European market as well. We've seen a lot of companies in the airline industry come out and say that they're going to be putting people on leave, that they're going to be stopping hiring. Lufthansa here in Germany, Air France has also made similar announcements. And one analyst estimated that this could cut 100 billion euros from the airline industry's revenues this year.
Chelsea, can I just ask you really quickly, are we going to see emergency action from central banks?
Emergency action from central banks is really in the spotlight today. A lot of investors think that the central banks, the Fed, the ECB, need to come out and really reassure markets and investors and consumers right now. But so far, what we've heard from central bankers, including Christine Lagarde here in Frankfurt yesterday, was that they don't really believe that this is going to be a long-term economic problem, and they're not really ready to step in with interest rate cuts.
Chelsea Delaney in Frankfurt there for us, and Andrea Heng in Singapore. Thank you too. Well, a look at the effects the coronavirus is having on certain sectors now. Officials calling off the Geneva International Motor Show, the biggest in the world. It was scheduled to begin next week, but the Swiss government has banned gatherings of 1,000 people or more. Last year, over 500,000 people attended. British low-cost airline EasyJet says it's witnessed a significant softening of demand as a result of the virus. The drop is primarily on flights in and out of its northern Italian bases. So far this year, EasyJet's shares have fallen more than 20%. And British Airways says it's expecting a drop in profits this year due to cancelled flights off the back of the coronavirus. Flights to and from China, Italy, Singapore and South Korea have been cancelled. The growing spread of the coronavirus is sparking the sell-off of so-called pandemic bonds. They're an initiative of the World Bank. The bonds aim at shifting some of the burden of preparing against the pandemic onto financial markets instead of low-income countries most at risk of a pandemic. But now, as the risk of a coronavirus pandemic grows, the potential for a payout on the bonds shrinks, and that sparked the sell-off. Our reporter Arthur Sullivan is following this story for us. This is very, very timely, or untimely, I guess you'd have to say, Arthur. Are these holders basically cutting their losses?
Yeah, Ben, that is basically what's happening. So, as the report just said there, when the World Bank brought these funds in 3 years ago, there were two different tranches of bonds. Now, the riskier of the two is the one that we're talking about now. That bond had about 100 million worth, which was sold to investors. And those investors have been getting rid of those in the last week absolutely as quickly as they can, because their value is essentially worth nothing anymore, because they know that the conditions have been met for those bonds to be now paid to, as you said, low-income countries. So, yes, in that sense, they are cutting their losses on that particular tranche of the bonds. The other, less risky tranche that hasn't, those conditions have not yet been met. So in that case, they're still making some money for the investors.
So they've made some money. They're cashing in early, cutting their losses. Where does it leave low-income countries? They're the ones who were hoping for this money in this sort of situation.
Well, that's the big question about these whole pandemic bonds, and they have courted controversy from the very beginning. So if you look at it from the point of view, are they working? From an investor point of view, which is obviously the least important concern here, but they have worked to an extent. Lots of investors, lots of hedge funds have made some money from these. But the most important reason behind these pandemic bonds was to get money to poor countries, and all countries really, but especially low-income countries, in the event of a pandemic. And the ultimate proof to show that these don't work is if we look at the original idea came from the Ebola outbreak in West Africa between 2014 and 2016. The bonds were brought in, and yet in 2018, when there was a new outbreak of Ebola, the conditions were not met in the Democratic Republic of Congo for the money to be paid to that country, which is a very low-income country and which needed the money. The reason the conditions weren't met is because the virus at that time, the Ebola virus, did not cross an international border. So even though you had more than 2,000 deaths from Ebola in the Congo at the time, the conditions for not one penny of this money was met to be paid simply because it hadn't crossed a border, despite the size of the country.
So what are you saying? That the pandemic bonds, we already knew that they don't work?
Effectively, yes. And lots of experts in this area have said the same thing for years. If we look at what they said, for example, Olga Jonas, she worked at the World Bank for 3 years. She's now at the Harvard Global Health Institute. She's extremely critical of them for a long time, long before the coronavirus outbreak. She said in a very interesting article she wrote for the magazine journal, the scientific journal Nature, a few months back, she said, this structure of financing has been very good for investors, but not good for global health. Larry Summers, former US Treasury official in the Clinton administration, he described them as, I think, goofball economics or goofball finance. So no, they've been relatively good for investors, not good for developing countries.
Arthur Sullivan, thank you very much. And nice doing business with you.